afternoon this Thursday, September 2nd. Well, for those of you that are panicking that corn is going to $4.50 and soybeans are going to $11, we need to have a conversation about what actually happened this week. What happened was a horrible hurricane hit the Gulf Coast, where 60% of our exports go out for corn and soybeans, along with wheat, which also goes out at Galveston and Houston. And this pretty much put an end to export activity for probably 2 weeks. They say some are going to be going within 10 days of the hurricane, but overall it may take up to 3 weeks to fix damage. Cargill has a broken leg on one of its elevators, and the power to be restored in a lot of these areas could take that long. But there's an army of electricians being sent from RECs around the world that are heading to help out in this great task. Now, in regards to what to expect, all we have to do is go back and look at the last major hurricane, which was bigger than Ida, Hurricane Katrina in 2005, and it hit landfall at the end of August, around August 29th. Same as this one, so we have same comparables to go to. What happened that year? I'm going to walk you through a few things. Let's read the stories, and let's look at the results, and then we have some more charts to take a peek at. I went back and pulled some news clips. This was off of Business Futures. There was our corn and soybean digest. They talked about it, and this was after the September, Richard Brock wrote this, after the September 12th crop report in 2005. And the basic concept that came from this is that the USDA's World Agriculture Outlook Board said that supply and demand impacts of transportation and port disruptions caused by Hurricane Katrina were presumed to be temporary based on available information. That was with the crop report. They didn't adjust any exports. Now, here's another one. This was at the conclusion, and you can find these, you can Google these up and find these stories, the effects of Hurricane Katrina. You can find this actual story. But from their abstract at the very end, what was the conclusion? But simply the fact that damage caused by Hurricane Katrina did not have any effect here. I'm reading right here, this bottom sentence here, did not affect fundamental supply and demand factors. Rather, they only affected transportation logistics. I can find you more stories, but I'm not going to bore you. The reality is, when we went through 2005, that crop year through 2006, we kept increasing our yields. 2005 was also a pre-ethanol mandate time, so a little different action to expect also. So every month they were putting out more crop, and every month they were increasing exports. So in fact, after the Hurricane Katrina occurred and we got into January and February of the following calendar year, but still in the same crop year, they were increasing our exports. Do you understand we have 52 weeks in the year? Yeah, that major export terminal probably out for about 2 weeks on average. Some are going to open in 10 days. Some will be out for 3 weeks. So we're out 2 weeks. It's just the 50 other weeks. That 60% is going to be really busy. There's going to be some overtime, and there's likely going to be a lot of weekend work. But the exports that everybody is freaking out over are not going to be missed. The best thing that can happen is there's no social media. We didn't have social media in 2005. So everybody's yelling and screaming how terrible and bearish this is. We have a massive demand base coming that the USDA has proven they do not know how to read, because I have other stories I'd like to share with you, but I don't have the time. One of the big stories that the USDA does prove, as I've seen today, in the last 8 years, the USDA has underestimated at the beginning of the crop year corn demand by 100 to 900 million bushels. Do you understand what I just said? 2/3 of the time, they underestimate demand by 100 million to 900 million bushels. Just being off 100 million bushels this year is a big deal, let alone 200 or 300. We anticipate that displaced buyers of Brazilian corn are going to find their way to the U.S. to buy anywhere from 250 to another 400 million bushels of corn. USDA is going to blow this. Here's another little stat I found out today. In the last 4 years, the soybean yield that the USDA puts out on September 10th has a statistical likelihood of being a half a bushel to an acre too high to 1 3/4 of a bushel too high. So in the end, if they bump it a bushel higher, it's going to be extracted later on in time. And the reality is, carryouts, soybeans will be tightening up as the year goes forward. And we have a La Nina issue developing in South America that's going to be planting in a very dry ground, and the prospects of it staying dry into January and February continue to be very real. So let's go take a look at another phenomenon I've been waiting to share with you today. And annually we do this. Old customers know this. And it's the Labor Day low effect. And now how convenient this Hurricane Ida comes along, breaks the grain market down out of a very tight, congestive area. Soybeans hovering near 1330, 1350. Corn was hovering 540, 550, going nowhere, and now we were able to break it down on a story. Let's go look at this chart. Every blue arrow denotes the first week of September. Down here I have the years. Here's 2019, here's 2018, here's 2017, here's 2020. Now, in 2020, because of the pandemic, we had a weird year. We had our lows made early in spring, and I said that was probably the worst valuation of the year, and it would be higher after April of 2020. Well, it took a little time, but in front of Labor Day, actually early August was the bottom because of that storm we had in August, and of course, then we eventually burned everything up to finish the year out, and of course, the rest is history. But just to show you, here's Labor Day of 2020. Here is Labor Day week of 2019. Pretty accurate bottom. Here's Labor Day of 2018, the Chinese trade war year, where bottoms were actually put in earlier, but we still had a little drop into the opening of September before lifting again. 2017 was a little more unusual. We stopped the overall decline into the first week of September, saw consolidation for several weeks, and then 1 week blowout low, Thanksgiving, and then we turned higher. But what I want you to see from this, the bulk of the decline was over by the first week of September. Went sideways mostly for weeks, with then one large blowout to the downside over a week or two. Let's keep going backwards in time. Here is 2016, Labor Day low. Well, low came early and they re-challenged it on Labor Day, turned higher for the rest of the fall. Into harvest, yes, into harvest. 2016, low came early, moved higher until October, and then we came back down for a November retest low, but the overall low came in on the spot price before Labor Day. Same thing goes for 2014. We had a low come in just a little past. This was Labor Day week. It actually went till October, and the reason for this is we were coming off the 2012-2013 drought pricing, and we had came from higher valuations already from earlier in the year at 520 and slipped lower after Labor Day by a factor of 3 weeks. Going back farther, we have whenever you rally into Labor Day week, it's a high. There's September 12th. There's a high for 2011. 2010, low came early. Market was already turned up. Let's go back some more in time. Here's 2010. Market turned higher already in June and never looked back. Here's September for 2009, a stagnant market all summer, turns up in the fall. 2008 was the year of chaos, and that year we had already made a high in June. The market was free falling into the chaotic equity problems, but we had bounced into Labor Day. Here was a turn, Labor Day turn. 2007, looks like a Labor Day week turn. Let's go back again. Here's 2006. Turned a week before Labor Day. Now, let's go to 2005. Now, here's the problem with 2005. Here was Katrina. As you can see, prices were stagnant for several weeks. They didn't even acknowledge the hurricane. They knew the exports would come. They didn't have social media back then. And then, of course, the crop kept getting bigger every single month, and we declined until November. These are weekly charts. We declined until the November low was in, and then turned up, because the USDA kept cranking up exports. But this was Katrina. It did not create the chaos that we saw this week because, frankly, social media, the panic, the willingness to want to drive this market down from $5.50 corn and $13.40 beans, well, it was just too much to pass up. So away we go. Well, here we are. Here's December corn dropping to our now what is trend line support, bouncing, but I wouldn't get excited yet. Next week could still see a challenge of the 200-day moving average. We need to see some amazing strength tomorrow to get back above the 100-day moving average, because until we climb above it, the market is just sell momentum. It doesn't want to stop until it gets a greater opposing force to turn us back up. And that's got to have enough power to get us through the 100-day moving average, so we can say, in fact, that if this was the bottom of wave 4, this was a walk up to wave 1. This was a hard wave 2 to a 786. Now we're going to start wave 3 of an ultimate wave 5 advance. But baby steps. We got to get the low in, and maybe it slips lower. I don't know. Maybe it doesn't. We just got another week of time in here. It seems like we have an event up here in North Dakota called Big Iron mid-September, and the grains like to bottom around Big Iron when it goes beyond Labor Day. Even March corn, same look, holds trend line, but today's action, couldn't even recover most of yesterday's losses. Instead, just a little bounce. So if we can't get above this valuation here tomorrow, I think our spec trades we're just going to abandon and just wait until Tuesday to reapply in case they want to push lower into the Tuesday after Labor Day. Soybeans, the only victory here was yesterday's close was essentially at the low made on the EPA blowout low back in mid-August. Today's rally was just kind of a dud if you look at it. We are in this downtrending channel. What I want you to see from this, and let's just kind of zoom out. This was a bull move. This was not a major top. This was likely an A, B, C pullback where everybody believes we are heading back down to $11. They're taking this as wave 1 down. This is wave 2, wave 3. The problem is this wave should be more aggressive than this $2.50 drop that occurred over 2 weeks. The fact it is taking its time and zigzagging means it's in a bull flag formation, meaning the reconciliation of bull flags is higher. The catch is finding the low. I still believe this is our summer low. These are retracement lows, and it's just a matter of time to get us pushing higher. What's the USDA going to say on September 10th? Well, whatever it is, we know historically they've really been blowing it, and that this year they're probably going to be a half a bushel to 1 3/4 a bushel too high, which means carryouts are probably still heading lower on beans. Wheat today, we are getting close to our 60-day cycle turn next Tuesday, Wednesday. The window opens today. Kansas didn't tell us much. We had an inside trading day. Chicago wheat punched a new low, but held our moving average support. So that might say maybe there's a low in here, but we're not doing a full ABC measurement. There's still room, like I have in the newsletter. We could get down to lower valuations into Tuesday, Wednesday. We'll see. And when it gets down to the few days, close counts and horseshoes, hand grenades, and commodity markets. But then again, our wheat market looks a lot like French milling wheat, doing a whole lot of nothing. The blind leading the blind. We had that August high, a quick $3 drop, three-day drop, I should say. And then we moved higher, and now we're stagnating, waiting for this bull market to find new buying interest. So I hope you understand this Hurricane Ida definitely played into the bears' hands during a very negative seasonal time window when most people like to see the grain prices decline as end users sit on their hands hoping for a break, whether it's a USDA break or something this time of year that comes along like a good old hurricane in the Gulf. This is offering opportunities for end users for feed buying, along with ethanol plant procurement pricing. This is a place to be buying as a big demand base is coming for corn, whether they raise yields a bushel or decline yields a bushel in the upcoming September 10th crop report. This is Eugene Grainer with Heartland Investor Capital Management. I hope you find this information useful.